I am Kumuda, Assistant Professor, Department of Commerce. In this video, we are going to see the capital account in partnership. After preparing profit and loss appropriation account, we are going to prepare the capital account. There are two types of capital account, fixed capital and fluctuating capital. The problem itself, they have given that whether the capital is a fixed capital or fluctuating capital. So from that, we can prepare the accounts. So first one is fixed capital method. The name itself, we can understand that fixed capital means the capital, that is the opening capital, is standard till the end of year. If it is any additional capital, means that amount is added to the opening capital. There are no other adjustment entries are entered in capital account. So there are two accounts are opened in fixed capital method, that is partners capital account and partners current account. We will see one by one the specimens. First one, partners capital account. In this account, we have entered only the opening capital in the credit side of capital account, and the additional capital is also entered in the credit side of capital account. Then we can total the partners capital. The amount is carry forward to the next year. Next account is partners current account. In this account only we have entered all the adjustment entries. Then we are very well know that what are the adjustment entries. Interest on capital, interest on drawings, interest on loan, partner's salary, partner's commission, and apart from that the salary, that is the drawing, is also included. So all the adjustment entries are entered in the partner's current account only. If there is any opening balance is given in the current account, then that is also entered in the credit side of current account. From the balancing figure only we have started the current account. After that we have entered interest on capital on credit side, salary on credit side, commission on credit side, because all these entries, that is these all are the amount credited to the partner's capital. These are all the incomes of partners which is given by the firm. So we have entered all these entries in the credit side. Next, the drawings, interest on drawings and loss of shares are entered in debit side, because these are all the amount which we have taken from the partner's account. So these amounts are debited in the partner's current account. So these are all the entries are entered in partner's current account. These two accounts are opened in case of fixed capital method. Next one is fluctuating capital method. The name itself we can understand, the capital amount is fluctuated from the beginning to the end. All the adjustments are entered and made on the partner's capital account itself. So the opening capital and the additional capital is also amount is vary for the adjustment entries. This is the specimen of fluctuating capital method. So only one account is prepared, that is partners capital account. This account is started with the opening balance in the credit side by balance brought down. Then interest on capital, salary, commission, share of profits are entered in the credit side. Drawings, interest on drawings, share of loss are entered in the debit side. The balancing amount is carry forward to the next year. In this account, the share of loss and share of profit we have already calculated in the profit and loss appropriation account. That amount is transferred to the profit partners capital account. Next we will see what are the difference between fixed capital and fluctuating capital. First one, the capital remains unchanged in case of fixed capital. It is changed in case of fluctuating capital. Next one, there are two accounts are opened in case of fixed capital, that is partners capital account and partners current account. There is only one account is opened in case of fluctuating capital method, that is partners capital account. Then capital account always shows a credit balance because no other adjustments are entered in the capital account, but in the current account sometimes it shows a debit balance, sometimes it shows a credit balance. In fluctuating method, capital account always shows a credit balance. Then in fixed capital, all adjustments regarding to partners are recorded or entered in the current account only. But in case of fluctuating capital, all the adjustment entries are recorded in partner's capital account itself. So these are all the major four differences between fixed capital and fluctuating capital method. Next we will see the problem in fixed and fluctuating capital. In this problem, Samir and Yasmin, two partners are there. Their capital at the beginning is 15 lakh and 10 lakh. They have agreed to share the profit in the ratio of 3:2. They are required to prepare capital account if they are fixed and if it is fluctuating. So both the methods they are required to prepare a capital account. So in the other informations, they have given that additional capital on 1st July, Samir introduced rupees 3 lakh, Yasmin introduced rupees 2 lakh. Interest on capital is 5% for both the partners. Drawing is made on Samir is 30,000, Yasmin is rupees 20,000. Interest on drawing is directly given in the problem, that is 1,800 for Samir and 1,200 for Yasmin. Then salary only is given to the Samir, not to the Yasmin. Then commission, both the partners they can get a commission of 10,000 and 7,000 respectively. Share of loss is given in the problem as 60,000 and 40,000. That means we need not prepare the profit and loss appropriation account. They have already prepared the profit and loss appropriation account and the loss of that account is given in the problem. So we directly go for a capital account. So from this problem, what are the workings we have to do? So first of all, in all the problems, we have to do the workings first. Then only we can open the account. So in this type of capital account, we need to calculate interest on capital, interest on drawing. But in this problem, interest on drawing is directly given in the problem. So we have to only calculate interest on capital. The interest on capital is 5% per annum. So from the opening capital, we have to calculate the interest on capital. This is the calculation for interest on capital. For Samir, 15 lakh is the opening capital. So throughout the 12 months, they have calculated 5% is 75,000. In additional, they have introduced only on 1st July. So they can use the amount only on 6 months. So interest is calculated only for the 6 months, that is 7,500. Total interest on capital on Samir is 82,500. Next Yasmin. Yasmin introduced rupees 10 lakh as a opening capital. So for that 5% 50,000. Additions they have also introduced on 1st July 2010. So for 2 lakh 5% on 6 months is 5,000. Total interest on capital is 55,000. So we calculated the interest on capital. Then we go for a capital account. First, if the capital is a fixed capital, if the capital is a fixed one, we have to open two accounts. First one is partners capital account. So in that we will enter only the opening balance and the additions. So just we have entered the opening balance in the credit side. For Samir it is 15 lakh, for Yasmin it is 10 lakh. And in addition, Samir it is 3 lakh, for Yasmin it is 2 lakh. The total amount is entered in the debit side. The amount is carried forward to the next year. Then partners current account. So in this account only we have adjustment entries are entered in this account. There is no opening balance of partners current account is given. So there is no opening balance. So directly we have entered the adjustment entries to drawings. So all the amount which we have debited the partners account. That is, we have taken the amount from the partners is entered in the debit side. The amount which we have given to the partners is entered in the credit side. May I clear, girls? So as per the rule, that is the golden rule only, we have entered all the entries. So two drawings rupees 30,000 for Samir and 20,000 for Yasmin. To interest on drawing is directly given, so it is 1800 for Samir and 1200 for Yasmin. Share of loss is entered in the debit side. If it is a share of loss, we will enter in the credit side. Then in credit side, interest on capital, partner's salary, then partner's commission. So all the adjustment entries are entered. We find out the balance carried on amount. So from this, the partner's current account is over. So these two accounts we have to prepare if the capital account is fixed. Next we will see the same problem in fluctuating capital method. In fluctuating capital method, we will prepare only the partner's capital account. So from the opening balance, we will start with the credit balance. So 15 lakh for Samir and 10 lakh for Yasmin. Then additional amount by bank 3 lakh, 2 lakh. Then the same entries, what are all the entries we have entered in the current account is same entries are entered in partner's capital account. To drawings, to interest on drawing, to share of loss. Then in credit side, by interest on capital, by salary, by commission. The balance amount is transferred to balance carry forward, then the next year it should be brought forward. So this is the only account which we have prepared for fluctuating capital method. So I hope you all understand from this problem from fixed and fluctuating capital method. Then we go for capital ratio. So capital ratio means the ratio which we have taken from the capital. We all know that the share of profit is always dividing from the within the partner as per their agreed ratio, which is given in the partnership deed. If it is not given in the partnership deed, they can divide the profits and losses equally. Sometimes in the problem they have given that the profit sharing ratio is as per their capital. So that time we have to prepare the capital ratio. So how can we prepare the capital ratio of partners? From the example we can easily understand how can we calculate the capital ratio. So for that we will see this problem. Ram and Lakshman started a business on 1st January 2010 with a capital of 32,000 and 20,000 respectively. They agreed to share profits in the capital ratio. So the problem itself they have given that the share of profit is as per their capital ratio. So capital introduced is on one side and capital withdrawn is on other side. So Ram and Lakshman, there are two partners. Opening capital is already given in the first line of problem, that is 32,000 and 20,000. After that, on 1st March, 1st April, 1st June and 30th September, in these days, they have introduced some of the amount or withdrawn some of the amount. So from this much of confusion, how can we calculate the capital ratio of Ram and Lakshman? First of all, what we will do, first we have to calculate the capital of Ram. Then we have to calculate capital of Lakshman. So first, capital of Ram. So there are 4 columns we have to provide. First one is date, then capital amount, number of months used, then the product of capital and the number of months used. So what are the dates are given in the problem? I have just noted. That is 1st January, then 1st March, 1st April, 1st June and 30th September. The 1st January, 32 is the opening balance of Ram. Then 1st March they have introduced 7,000. So from 1st January their capital amount is 32,000, but in March it is changed to 39,000. Girls, first of all we all know, we should know that the addition is added to the opening capital, then the drawings are deducted from the balancing capital. So we have to add the addition, we have to deduct the drawings. On 1st March, the Ram made the additions. So we have to add the 7,000 to 32,000. We get a capital of 39,000. But the 1st January 32,000 amount is used wholly for 2 months, that is January and February. 1st March is on 1st March on self the amount is changed. So the number of months used for the 32,000 is 2 months. The product of these two is 64,000. On 1st March the capital amount is changed as to 39,000. This amount is till 1st April. So the amount is wholly used for 1 month. So the product of this March amount is 39,000. Next 1st April the capital amount is changed to 29,000, that is they have made a 10,000 drawings. So we have to deduct the 10,000 from the 32,000, we get a capital of 29,000. So 1st April to 1st June, that is whole of April and May, only 2 months we will use the 29,000 amount, we get a product of 58,000. On 1st June, the amount is raised to 42,000 from 1st June to 30th September, that is June, July, August, September 30th. So we have added September also. There are 4 months we use 42,000. So the product amount is 1,68,000. On September, they have withdrawn the amount, so we get a 17,000 as a capital amount. This amount is used up to 31st December. So 30th September they have withdrawn, so we just leave that month. After that October, November, December, there are 3 months used the 17,000. So the product of this 17,000 and 3 is 51,000. So we will total all the products. We get 3,80,000 as a total capital of RAM. Likewise, we will calculate the capital of Lakshman. So in this problem, we will get a capital amount of Lakshman is 3,80,000. So finally, we calculate the capital ratio between Ram and Lakshman. 3,80,000 is to 3,80,000. So 1:1. So likewise, this only we will calculate the capital ratio. I hope you all understand the capital account and capital ratio. Thank you, girls.